Okay, student, today I want to give you introduction on effect on accounting equation or accounting equation as a whole. You must know the equations that says your asset is equal to owner's equity plus your liabilities. That's what it says. Asset is it's what the business is owning, not owing, but owning. And then owner's equity, this is the position of the business. All the incomes and expenses that is being paid and received by the business happens here. And whatever a business is owing, the liabilities, it's in here. So what the business own and what the business has at its position and the liabilities, when these two are added together, they are equal to your asset. So asset, if you minus one of these two, you're going to have the other one. For example, if you minus equity from your asset, you're going to result on your liabilities. If you minus liabilities from the asset, you're going to result on your owner's equity. So okay, let's check the assets first. This is the asset column. Asset, we have two different type of asset. We have our non-current asset. We have non-current asset, and we have our current asset. What's the difference between the two? Our non-current asset, it has to do with the followings: land and building, furniture, equipment, machinery, and investment. Current asset, it's your debtors control, your bank, your cash, your inventories, and all those stuffs. How do these two differ? Non-current asset, you are not permitted to convert these things to cash within the period of 12 months. You must wait the whole period of 12 months in order to convert them to cash. Current assets, you can convert them to cash even within the period of 6 months or so. For example, if you're using bank, for example, as an ABSA, you can change the business to Standard Bank, Nedbank, and all those stuff. But if you have buildings in your business, you can't just decide to convert them to cash, because some are being rented by the, what can I say, are being rented by people or tenants. So you have to give them a notice, and it must be the whole year. So okay, let's see. Asset increases on the debit side. Asset increases on the debit side. Is an increase on the debit side. Decreases on credit side. So you must be familiar with this part. Asset increases on the debit side, decreases on the credit side. Let's take for instance land. If you purchase land, you're increasing the asset account because you're coming with something in the business, so it's a plus sign. If you sold land, you're decreasing the asset, meaning that it must be on the credit side, which is negative. Same as building, same as furniture, equipment. Whenever you do purchases, it's going to be a plus sign, and if you sold one, it's going to be a minus sign. Debtors, when people are sold, when goods are sold on credit, meaning that those people, they are owing you, so they're increasing the debtors control account, which increases the asset account. And it decreases when they pay. So when they pay, it's a minus sign because it's decreasing the asset account, since they're not going to owe you. Bank payment, each and every time if you make payment, you're decreasing your asset because money is going out from the business. If you receive bank receipts, it's a plus sign, it's increasing the assets account. Cash, if you have money on hand, cash on hand is something that you have either in a business or at the bank account. It's a plus sign because it increases an asset. When you do withdrawal, you subtracting from your asset. So this is how you deal with asset. It's an increase whenever you purchase or you receive something or you sold goods on credit. So let's jump owner's equity and come to liabilities. Liability, these are debts. If a business go and acquire a loan to the banks, it increases the liability account because at the end you'll be owing the bank because you took a loan. When the business is given a loan or a bond, and it decreases when the business pays. When you pay back the loan, you're decreasing owner's equity. Creditors, if ever you bought something on credit, you're increasing your creditors, and whenever you pay them or return the goods, you're decreasing your creditors. Okay, where does it increase? Where does it increase? Liability increases on the credit side, and then decreases on the debit side. So your liabilities increases on the credit side and decreases on the debit side. So it's vice versa of what? Of the assets. This one increases on the debit side and increases on the credit side and decreases on the debit side. So it differs from your asset. It differs from your asset account. So let's come back to owner's equity. Owner's equity, we have incomes. Under owner's equity, we have incomes and we have expenses. They're saying item that increases owner's equity, item that decreases owner's equity. So items that are this side, sorry on my highlighting, item that are this side. Let me start from here. A lot of damage is happening. Items that are this side, probably this side, excluding the expenses, this increases owner's equity, and from here going this side, I think it's from here going this. The logic of this thing cannot allow me to highlight, but then item like this decreases owner's equity. That's why they specify here. Other item decreasing owner's equity, other item increases owner's equity. So incomes increases owner's equity, expenses decreases owner's equity, and then the other item that increases and the other item that decreases. Okay, where does it increase, where does it decrease? And B, increases on the credit side, decrease on the debit side. So it seems like owner's equity behave the same as liabilities. Okay, what are items that increases owner's equity? Incomes increases on the credit side and decreases on the debit side. Credit side, it's a plus sign, and then debit side, it's a minus sign. Sorry, it's a minus sign. So incomes behave the same as owner's equity. Increase on the credit side, decreases on the debit side. What about expenses? Expenses increases on the debit side, increases on the debit side, and decreases on the credit side. So expenses are similar to assets. So meaning that this one is, the income is similar to owner's equity, while expenses are similar to asset. What are incomes? We have rent received. Each and every time, whenever we rented buildings in our business, people will pay rent and we're going to receive it. It's a plus sign. If we render a service, either cash or credit, is going to increase our incomes. Discount, if we make a discount, if we have a discount received, we bought something, they give us discount, or we pay, they give us discount, is going to increase our incomes. Commission received, incomes from the commission, even if you made sales or something and then you get a commission. Credit losses recovered, people who ran away with our money, now they're coming back and they are paying. It's an income. Interest on savings account, if we made a fixed deposit, now we're receiving interest or on investment. Interest on fixed deposit, what I just explained. So other item that increases owner's equity, our capital contribution. If an owner contributes the business, we're going to receive that money, so it's an income. If we make sales, item that decreases owner's equity from expenses, all the expenses, packing material, they are decreasing owner's equity. That's why you see all of them with the minus sign, minus, 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 but they are increasing expense account while they are decreasing owner's equity account as a matter, because they are inside. So all expenses decreases owner's equity. So these are expenses: paying material, advertisement, rent expense, salaries, discount allowed, rates, credit losses, interest on loan, water and electricity, municipal expenses, all those stuff. Other item that decreases owner's equity, it's your drawings, your cost of sales, your sales returns. So you must be able to understand this structure, and after understanding this structure, you will be able to deal with accounting equation in the form of transactions, because each and every time when you read the transactions, you must be able to identify two accounts that are affected. For example, let me give you a transaction on my own. Let's say they're saying what? Paid water and electricity by check. Is it this one? Sparing. Yeah, paid water and electricity by check for 500. You must be able to determine two accounts affected. And what you must know, two accounts affected. Two accounts affected. You must be able to determine two accounts that are affected. How do you? Always, when accounting for two accounts affected, in a transaction, you will be given one account affected. The other one, you must understand the nature of a transaction. In this case, the first account that is affected is water and electricity. That's the first account affected. Water and electricity is the first account affected. And then the next account that is affected, once you hear the word paid, money went out from the bank because you paid. Either you paid by check or cash, but then monies went out of business, because if you pay by check, they're going to cash that check. So another account that is affected is bank. So we have two accounts affected, because normally they start from two going forward. So how do we allocate the debit side and the credit side? Because we must get the account debited and account credited. How do we? If we pay, amount is getting out from the business, so meaning that our business is decreasing. Our bank, I mean to say, our bank is decreasing, and this decreases what? Asset. I said asset decreases where? On the credit side, since they say credit side, so it's minus on the credit side. Let me use this one. On the credit side, water and electricity, it's an expense. Expenses, I told you that they increase on the debit side, but we always know they decrease what? Owner's equity. And on accounting equation, we only have these three. We don't have expenses when we're recording. They are inside owner's equity, so we're going to treat it as owner's equity. So owner's equity, since it's an expense, it's decreasing owner's equity. It's a minus sign. Owner's equity decreases where? On the debit side. So account debited is water and electricity. Account credited is bank, because each and every time you must have account debited and account credited. By how much? By 500,000. By 500,000. This is how you're going to record under effect on accounting equation. How do you record? Let's take for instance and recording this transaction on accounting equation. And recording the transactions, we're going to have, this is what we have: account credited, normally this is a structure, account debited, and then here we have our asset, here we have our owner's equity, and here we have our liabilities. Account credited is this one, account credited, credit side. So account credited is bank. This is how you record it, bank, after analyzing. Account debited, it's water and electricity. So account credited, it's water and electricity. Yeah, electricity. Effect, bank is your asset, so you're going to have minus 500 here, as it is in this case, minus 500. Minus 500, the minus is here inside this bracket. And then water and electricity is an owner's equity item because it's an expense fall under owner's equity, so minus 500. And then liability, nothing happened, it's 0. And here remember it says owner's equity plus liabilities. So this means that minus 500 plus 0, it must give us minus 500, since the equation says asset equals to owner's equity plus liabilities. So this is how you record your effect on accounting equation. You're going to see this clearly when we are attempting a question, but in this case you must be able to understand the structure and know some of the items that forms the transactions, know the accounts, get more incomes on your own, Google them and everything, Google expenses, non-current asset, liability, so that you know, okay, which items fall under what category, which items fall under what that category, until we meet on the session for effect on accounting equation. Thank you.